we may be at a relative scale of outperformance given what is happening in the recent world. But given that now markets are perhaps reaching that phase where valuations are not exactly cheap, triggers are absent, and major part of the re-rating in individual stock has already happened. Where do we go from here? What's next in terms of a trigger? What's next in terms of a theme? And what is the way forward for some of the consumer tech and fintech stock after the grand comeback in the first half of 2023? Let's take some of these pointers forward with Hiren Ved of Alchemy Asset Management. Hiren, fantastic to have you back. Thank you for joining us.
Thanks, Nikunj. Always a pleasure.
Likewise, it's turning out to be a good year.
Yes.
When the year started, nobody anticipated any kind of, nobody was prepared for a double-digit gains on index and even on individual stocks. But last 4-5 months, I think we've seen a breathtaking rally.
Yes. And you said it right. Not only a breathtaking rally, but the breadth of the rally has been pretty good, right? Yeah, I think from the Feb-March lows, it double-digit plus, right? In the both Nifty and especially small and mid cap have done exceedingly well. But Nikunj, if you look at a slightly longer term perspective, let's take October 21, which is when markets last peaked, right? The broad markets peaked. It also pretty much coincided with the Fed starting to raise rates, right? That is, I think in November was the first time in 21 when the Fed started talking about raising rates. And the broad markets corrected, right? If you look from October 21 to today, the rise in the market will look less spectacular. And the Nifty, for example, is up 3% CAGR over 21 months from October till date, October 21 to date. The mid-cap index is up 7-8% and the small-cap index is also up 7-8% CAGR. So essentially, you've broken out of a long consolidation phase between October and March this year, and then from April onwards, you've seen a surge. It's also because earnings breadth improved, because 22-23 was a very tough year for earnings, especially the first 9 months after the Russia-Ukraine war. Commodity prices just completely went off the charts, and all manufacturing companies outside of financials was the only pack which did well in terms of earnings, because they had the best metrics that you could think of, best NIMs, no credit cost, reasonably healthy, But outside of financials, there was a big impact on earnings because of rising commodity costs. That was also one of the reasons that you had a double whammy of rising rates globally and falling margins, which is why your broad markets didn't do well in 22. But that is now reversing in 23. You can say that while you don't have earnings, while you don't have rate cuts coming as yet, that's kind of got delayed, but at least you are peaking broadly. So you're not going to see rates much higher from here than where you are. And earnings are coming back because commodity prices are starting to come down. So I think this combination has worked for the broader markets. So I'm not surprised that, we always have this recency bias, because if in 3-4 months the markets really go up, we feel, oh, markets like too high. But as I said, if you take a slightly longer term view, it's not done anything great for the last 22 months, right? Also, if you look at another statistic, right, if you take the BSE 500 earnings pre-COVID, March 2020, I think the figure is somewhere in the region of 4.5 lakh crores. If you take March 23, those same top 500 companies, it's at 11 lakh plus crores. So your earnings have more than doubled, but Nifty hasn't doubled from 12 to 24 yet, right? So I think you have to keep some of these things into perspective, that I don't think, yes, we are not cheap, we are not very cheap, but we aren't exorbitantly expensive as well. And there's just so much of gloomy news outside of India that you feel that how come markets are so resilient.